Welcome to this week's Desk Side Chat. This week, our featured guest is John Reed, specialist in premium finance. John, appreciate you joining us this week.
Happy to be here. It's been a couple of months. I think the last time was February. So we're on a good 6-month run here.
Yeah, it's been a little while. You and I still talk on a regular basis, and our group is extremely fortunate to have you as a member sharing your expertise. Before we get into this week's topic, John, if you could provide a little bit of background on yourself, we certainly would appreciate it.
Sure. So I'm focused exclusively in the life insurance world, specifically in premium financing. I fell into this market completely on accident. In 2014, I met a team out here in Newport Beach who focuses on this. They were looking to expand their team, scale up their operations. And I'm an engineer by background. I think very systematically and repeatable. Once I really dug into what they were doing and how they were doing it for agents, I really just fell in love with the concept of financed insurance. It was something I'd never thought of or seen before. And once I really understood it, I realized how many places it was applicable. So fast forward a few years, now I run a team that's really kind of changing the business model on how premium financing is distributed. Historically, for the last 20 years, the way it's been distributed is that an agent or an advisor has a client that is considering purchasing a large life insurance policy, and due to opportunity cost or due to gift tax limitations or cash flow limitations, they choose to finance the insurance instead of paying for it directly out of pocket. In order to do that, though, the advisor would go out and either contact their wholesaler from the carrier they're writing through, or their BGA or their IMO, or call their buddies. It always starts with that, hey, I got a guy, or hey, I got a gal conversation. And ultimately they would lead to a premium financing aggregator. That's what they call them in our space. So a premium financing aggregator would come on board. They would redesign the insurance, design the loan structure, present it to the client, go out and broker the loan, and put the whole plan together for how to finance the insurance. And for this, that aggregator would take a 30 to 50% cut of the commission from the agent. So the agent paid for the aggregator to be part of the process. And what I've seen is that over the last 20 years, I don't know if it's one of those tail wags the dog situations, but people hear about premium financing and they think this is how you sell large policies. And I think it's the other way around, is that oftentimes people who have already chosen to buy large life insurance contracts, they choose to use financing due to some efficiencies. And so because it's been driven by that, it's planning driven, the relationships with lenders have become, there's more lenders in the space. And the advisors who are in this market already now understand how it works. Advisors aren't necessarily looking for someone to help sell the case anymore. What they're looking for is someone to help them go do the financing, just like they partner with the BGA for access to contracts to sell the insurance, or for help picking out the most efficient products. What I've started to build is a service that agents who are looking for access to banks, they can use me as an external loan broker. And so I go out to the market of lenders the same way their BGA goes out to the market of insurance carriers to make sure that we're matching the best price, the best loan structure, the right terms, and navigating all of that without any ties to any one lender or any one carrier. That's what I'm building now. So I have two businesses, if you think about it. One is that the traditional premium financing aggregator that works alongside agents, does joint work. That's my joint work life insurance business, and that's called PFLI, which stands for Premium Finance Life Insurance. I decided not to get very creative with the name. And then the second business is called PF Review, and that's the loan brokerage as a service. The vision for that is to actually have it an online offering where people can jump onto it the same way they would search for a home mortgage and find the best fit for their clients' banking needs for their premium finance transaction. So that's what I come from. And I know this is a longer answer than tell us a little bit about a background, but that kind of leads us to why we're here, which is that I started off my career with Northwestern Mutual. I was tied to one carrier. everything was a Northwestern Mutual. It was either permanent or it was term or it was a disability sale. And that's all you were taught. You were taught that everything basically funneled down to one of three specific products from one carrier.
Everything, right?
Everything.
Age, situation. It's like, I got a great solution for you, specific for you.
The
Go
Swiss
to,
Army knife of solutions. And so that's, I actually am very grateful for my time at Northwestern Mutual. I still own my Northwestern products. They've been excellent to me. They've definitely served that need. But being an engineer before I got into finance, what I found is that I don't believe anybody until it's been proven. And so when I started peeling back the onion and saying, hey, there may be better solutions elsewhere, internally that wasn't well received, because even though you're kind of told that you're a totally independent person, you're not. You're tied to that carrier. And so I decided, it's time to kind of move to a different route. And the same thing happened with premium financing. In 2015 with the other firm, it felt like every single case either went to Pac Life, Penn Mutual, and went to one bank. And I just didn't like that. But that, a lot of it was the source of those referrals. And I don't think there's anything wrong with those carriers, but there was no independent research done whenever it wasn't brought in by those carriers. And there was definitely no shopping the market for loans. And so that's really what my whole mission statement here is: transparency in the life insurance world, specifically in mine, which is this, the high net worth, ultra high net worth financed insurance space. And so when we started talking about topics for round two, something I'm passionate about is that I think there's a lot of marketing noise out there, especially in the life insurance world. And there's just a lot of nonsense and gimmicks that are played and presented to people. And even if you do this every day, it can get confusing. And so a lot of the folks who are part of the Good Advisors Finish First family, they're not talking insurance every day. They're not talking product every day. What they're leaning on is the help of specialists and external people to guide them in the right direction. And that's what I wanted to talk about, was how do you keep your eyes wide open? How do you not be willfully ignorant whenever things start to feel too good to be true? And that's something that an advisor I work with who's an RIA, I came in and I've been helping him work through a premium finance transaction that they put in place about 6 or 7 years ago. And this was one of those deals where the client, I don't know how familiar you are with these, John, but the client was presented a concept.
I know about them. Yeah. I mean, and again, this is why it's really helpful to have you as part of the group, is just to be that expert, because these are things, like you said, that advisors don't come across as often, but they can be incredibly beneficial, valuable opportunity and lucrative opportunities when they're done correctly.
So the way this was presented and sold to the client was that, hey, you're a rich family. You have some assets that are sitting on the side. If you post those as collateral for a loan, we're going to borrow money from a bank at a really low interest rate. We're going to use that money to max fund a large life insurance policy over the course of 5 or 6, 7 years. We are then going to see the cash value grow so high and so fast that you won't have to make any interest payments on. You'll be able to keep rolling those into the loan. So keep compounding the loan size, but it's going to be out compounded by the cash value, to the point where in the future, you're going to be able to do a participating loan against the insurance contract to pay off not only the bank, principal, all of the accrued interest at a later date, but also have enough cash value to keep this large life insurance policy in force forever. That's what's sold. And it's modeled very easily with the illustrations that are available. There's no regulations on what you can show for banking rates. So all of this was wrapped up into a presentation. I show up in year 6 and start to unpeel this. And the advisor told me, he goes, John, it's like, I don't think I was doing anything wrong, but I think I must have been willfully ignorant. And that's one of those things. When you look at this, that case, I think the commission on it was maybe $270,000. It's easy to get wrapped up in that. It's easy to lose track of what you're trying to do and who you're trying to do it for. And if you believe that, hey, even if this operates at 80%, maybe instead of them getting $5 million tax-free death benefit for nothing, 80% of 5 million is 4 million. That's the thought process, that if you apply this kind of this delta on performance, that it actually just gives you a less death amount. What I'm seeing though is that this client may not be able to afford to hold on to this thing in the next 3 years, because the interest is now compounding much higher than the policy is compounding. And so if they can't repay the loan, if they don't have the ability to accrue interest, now instead of having this free contract, the client's going to have to show up with $100,000-$200,000 of interest payments annually they weren't planning on. And so now it starts to say it's not just failure of 0% out of pocket to 80% of the deal. It's, we didn't hit the numbers and now the whole thing's going to fall apart because they didn't plan on $100,000 of cash flow to service this deal, and they were never presented that. So what I look for is, when I lean on a third party, it's trust and verify. I'm working with people I trust, and I want it broken out for me. I want to understand the mechanics. That's the nerdiness in me. I want to know. I believe everyone makes choices based on logic. They look at the numbers, they look at things, they look at, hey, this is what the presentation is. These are the assumptions that are used. And as long as it pans out, this makes sense to me. Where I think people fail to be critically minded is in the validity of those assumptions. And in life insurance, there's a lot of there's things that are inside the contracts. There's little switches and dials that the insurance carriers use to make sure these work in the long term. And those aren't being critically analyzed. Those aren't being stressed. I don't know if you paid attention to it, but there's in the last 5 years, there's been 2 versions of Actuarial Guideline 49, which is all about the insurance regulators changing and trying to limit how egregious and some would say egregious. That's me being critical. Some would say how well or what level of performance can be illustrated. But it's to get rid of the idea of showing a 12% return on an IUL contract, beating all of the investment returns, beating everything the client could possibly put their money to, and getting all this tax-free capital. It's to protect consumers. And so it's gone through multiple iterations, and that's been a byproduct of new regulations coming out, just dictating how a policy can perform, giving it specific triggering mechanisms, and then the insurance carriers creating new things to circumvent that. Some claim it's in the spirit of creating a more efficient product. I don't know if I buy that, because I didn't see those before. Those were never, those weren't objects that were created ahead of time. It seems to me like this was more about an illustration war. And even if it's not, that's great. But I want to help people think about these critically and ask the right questions and get the right answers to make sure that when you're presenting an insurance contract to your client, you understand how it works, you understand the mechanics. They're very complex. There's a lot of moving parts to it. And it's learning how to ask the right questions to your third party resources that are sending this information your way. That's really what I thought would be valuable to share with the group today.
Well, and big part of what we're trying to do, we've talked about, is turn the lights on, transparency, open up on all aspects of the industry. Last week, we had someone sign up for the group, non-industry related person who just must have come across the link. I talked to the person and I'm like, we're currently focusing on advisors right now, this Good Advisors community. And one of the interesting things, just talking to this person, was he had come into the group like looking for an advisor, and he's like, where do I start? Who would I talk to? And there's so much misinformation out there. There's so much that can be overwhelming to the end client, to make it confusing, and trying to find, what resources should I trust? Where should I go? It was difficult for me to really even help that person get a starting point. Same thing now in an advisor's shoes, right? There's so much out there. Whether it be the carriers themselves, whether it be the wholesalers. So an advisor comes across an opportunity. What's the starting point, John, with all this information that's out there?
I heard a few different questions, so I'm not exactly sure what you want me to answer.
If I'm an advisor and I come across an opportunity, where should I go first?
I think the first thing you do is go to your client. And it's asking them really what their goals are. It's the discovery process. And it's not just ending with, again, like my training was, hey, if you want to save for college, You would think about year one in the business. You want to save for college, and you have an income, and you owe your parents money for paying for your college, and you want to stock away some money tax advantage. You should put it in whole life insurance, right? I think the way you ask questions and the fact finding a lot of times guides that. And so I think it's taking that governor away, and really, it really starts off with the fact finding of the client of what do they want to accomplish when life insurance specifically. What I look for is to match products duration with the duration of the liability they're protecting. And so, said in another way, if the client is worried about their spouse living their lifestyle without the income that they themselves are providing, and part of the plan that you're putting in place is a way to become financially secure, financially independent, no longer income dependent, now you're wealth dependent. Well, that says to me that that liability, that income replacement liability, ends when they become wealth dependent. You no longer have that associated with it. And so that to me tells me that there's a term insurance solution to match the term of that exposure. At the same time, a lot of the clients I work with are looking at estate tax liabilities. And these estate tax liabilities aren't temporary, they're permanent. There's not a plan for them to give away their wealth or to structure their wealth transfer in a way where they're no longer going to have exposure at all. Or they fear that because this is a moving target, that the target's going to move further away and they're going to need the insurance for perpetuity. All of my sales in the estate tax planning and business planning place are permanent insurance sales. But I think getting that piece right up front is the first question. The second question is saying, on a short, medium, and long-term time horizon, what is that liability and what is the purpose of the coverage? Because if we have a family that's going to go from income dependence, where they want to insulate that, to wealth dependence, where they no longer have the income loss of one of the incomes would create catastrophic failure of the financial plan. But then at the wealth dependence piece, they now grow into the estate tax exposure, and their new fear is that they want to insulate all those assets for transfer to their children or to their family. Now what we see is that today there's a temporary liability for income replacement, but long term we plan on transferring that to a permanent liability for estate taxes. And so what I look at is, what are products that can grow with the family? What's a product that can cover for the short term and then also cover in the long term? And that's whenever you're requesting illustrations or requesting help from your BJA, it's really laying this out. And I think that sharing that we want to have coverage that does this for this period. It needs to be owned by this type of entities become really important in the estate planning place. It needs to be owned in a way where they have access to the cash flow or to the death benefit, followed by them having an estate tax exposure. That's a plan for the policy to now transfer typically to a trust outside of their estate. And it's asking the question, do they need access in the event of the premature death of one of the two primary income earners? Does the opposite need access to that cash flow? If they're no longer income dependent, we want to switch that over to an irrevocable trust that's outside of their estate for tax purposes. So how are we going to transfer it over to that? And now it's a permanent liability, so we need a permanent product. So in that kind of scenario where someone has emerging wealth, you start thinking about short term, we need access to death benefit for income replacement needs. It needs to be accessible to the surviving spouse. Long term, we need death benefit to cover estate tax exposure, and we need that owned in a way where they don't have access to it. That way, it's not included in their taxable estate. And so sometimes they don't break it down and look at cash flow requirements. How are they able to fund these contracts now? When would they start funding a permanent solution versus a temporary? And it's determining, is it the same product? Is it going to be one product that we convert to a permanent product? Is it a permanent product now that's minimally funded with a plan to gift it in the future and then fully fund it? Those are the kind of things you start thinking about. So when you present the case to your team for going out to the market, it's saying it needs to do these things. And then the last thing is being aware of the triggers. And it's asking them, hey, what all options do I have to stress this? Because what you're going to get back is taught to your BGA, it's taught to your wholesaler as typically the best way to illustrate something. It's going to be, here's how we can show it off the best. Here's the newest bells and whistles. I hear wholesalers tell me, well, AG 49A really limits how good we can show this. It should be much better. And that's, when I hear those words, my marketing sensitivity goes, that's a learned response. That's not someone looking at this critically going, holy cow, this is the best piece of financial architecture I've ever seen. I've never seen a contract that's so beneficial to a client that it's limited for how it can perform. What I hear is that's marketing. That's passive aggressive marketing attached to it. And so I asked the question instead is, hey, how can we illustrate this as boring as possible? How do we get rid of all the excess things that have been developed recently and stick with what's been around for 20 years? How do we use I ask for requests like this. I ask for them in the S&P 5 for index universal life. I ask for S&P 500 only, cap focused, not with no non-guaranteed bonuses or multipliers. And I always ask for the cost and charges page. And I think the cost and charges page is a really important thing to request, because when you open that up, you're going to see the truth. You're going to see what all is being paid for and what all is being credited. And it's by going through that page that sometimes you'll realize if you get an IUL, oh, Nick, yeah, big fan of cost and charges pages. Good. What you want to do is jump in it and see, is this being realistically run? Are there things that aren't being, I guess, given to me? Is there information or things I'm not aware of that are inside that cost and charges page that I need to dig into deeper? Two examples of that came up for me recently. One was we're working on a $30 million death benefit for a 48-year-old private equity guy. And we got an illustration back. One was run at a 5 pay and one was run at a 7 pay. And they were both max funded. It was about the same amount of premium going in over 5 years or 7 years to see which one would have more lift for the long-term design of it. And the 7-year was outperforming, which didn't make sense to me, because typically the 5-year funding, if we can get all the money in a shorter period, we get more compounding long-term, and the 7 pay was a higher performing. And so digging into cost and charges pages, what we realized was that one of the premium load values, the amount of money that the carrier is charging for management of the capital, was almost like cliff vesting. And in the first 5 years, I think there was $240,000 of charges. And in years 6 and 7, there was 17. And so that number being an order of magnitude off, it started making me wonder, hey, what's going on here? Call the representative from that carrier. Yes, the first 5 years have all these extra charges for the funding. This is how it works. Well, I've seen this before. And so my thought now is, what if we run a minimally funded policy for 5 years and then actually fully fund it in years 6 through 10? Can we get a lot more lift out of it? Now that's going to lose 5 years of compounding. So I don't know the answer, but those are the kind of questions you get to ask when you start peeling back things. And so it's not just taking things at face value. It's really digging into them. The problem is it's a full-time job. That's a full-time job to know what's moving inside these contracts. And so I think when you find a good partner, this is how I think you find a good partner. You find the person who thinks like you do. You find the person who's going to do the due diligence and peel back the onion. And when you ask them for an illustration, I always want to know, here's what we ran, here was the results, here's why we think this one is the best. I don't like people telling me this is the best. What I want to know is, here's how we analyze the market of products. So that's a really, really long tangent answer of how do you get started. But I think it's the right way. And so I guess I'll give you some practical knowledge. I would ask for a policy run on yourself. As an advisor, I would look at it and look down the barrel of it and say, is this something that I would buy? What questions would I have before I would pull the trigger on this? Because your clients naturally are going to be gravitated to thinking like you do. And so if you're going to do your due diligence or you're not, you're going to find a partner who's going to help you present illustrations the way that you think. That's just naturally how it's going to work. And so where I think that the digging into numbers goes is it's whatever level of critical analysis you would do for your own contracts that you have to do for your clients.
So great recommendation. And I want to open this up, John, to members of the community. Beyond that, this portion of the meeting is public. So if someone is looking to get in touch with you as a resource, what's the best way for an advisor to get in touch with you, John?
No kidding. The best way is to message me on LinkedIn. It gets around all of my text inbox. It gets around my email inbox and goes right to me. I run my own my own LinkedIn. So that's actually the fastest way to get in touch.
Outstanding. Well, we are very fortunate.
It's John Reed Jr. with rocket ships around it.
Yeah,
so easy to find me.
Your rocket ships. So we can talk more about that another time as well. But like I said, we're extremely fortunate to have you in your expertise and your mentality, right? Turn the lights on transparency. It's such an important thing, especially when we get into that insurance world and maybe, the premium financing, an area where advisors just don't spend, a lot of advisors don't spend a lot of time on, and it can be very overwhelming. So it's so important to have that help. So John, thank you so much for joining us this week. Really appreciate it.
Yeah. And I want to, whenever we bring people on, I want to talk about premium financing, specifically how to ask questions, because historically it's been used for large complex estates and families, and it's been taken down market. There's been some strategies to bring it down and use the concepts of leverage, use the concepts of arbitrage to create retirement income streams. And the majority of those, I think, fall into basically one camp, which is overestimating how well the policy can perform to drive the entire structure. And it's mass marketed. It's a way to sell larger insurance policies than someone would normally do. For many reasons, it's larger than normal because the qualifications to do it start at about $50,000 to $100,000 per year of funding. The average case is about $4,000 a year in the country. And also because it requires less out of pocket for the client. So the client sees that they're going to put a certain set of dollars in, and if they wouldn't go that route, they would get less money. And so there's some things that are wrapped up in a lot of the marketing that's going on right now around premium financing. I think it's really important for clients to be aware, or advisors to be aware. And also how to debunk it, because I think a lot of it's bullshit, to be frank. It's really, really destructive to the industry. And I think we're finally going to see a year where that's kind of proven out. And it's important that it is. It's important that it's shown to be a bad actor, because it hurts everybody. The life insurance industry, I talked to a venture capital guy, and he told me that the most creative marketers in the world are life insurance agents. And it made me laugh, because he goes, that every single answer you give them is a reason why you should buy. I don't like life insurance. That's why you should buy permanent insurance.
Yeah, I mean, well, and that's the case across the board, not just in our industry, just in society. And there's so much BS out there. But yeah, like you said, insurance is definitely unfortunately a primary culprit, because the whole premise, good advisors finish first, good people finish first. You'll be more successful in the long run if you just turn the lights on and start out transparent right out of the gate. So
and for investment advisors and financial planners, people who are looking holistically, insurance contracts play a really important role.
Yeah.
In a lot of these. And
that's the thing, people don't use them as often as they should because of all the negativity, unfortunately.
That's exactly right. And it makes total sense to me. If you're constantly seeing BS marketing and all this, all these lawsuits against it, and talking to people, especially talking to clients who have had a bad experience, talking to clients who have been putting money into a contract they didn't understand, and now they're 5 years into it, they finally meet someone who's a comprehensive planner, and you're looking into it, it's easy for that planner to start throwing rocks at it because it makes them look smart. It's that same thing with the the consultant who comes into the business. It's easy to throw rocks at what's already been built. And I think as an industry, one of the things we can do is find, hey, here's the value in it. Here's why maybe that was used. And here's, let's look at today going forward. Here's what you already have. Here's where you want to go. Here's how we can bridge those two together. It's figuring out how to be, play nice with each other. And part of that is also the insurance industry needs to self-regulate. I think that's something I talk about all the time, is that these problems exist because it's so easy to market insurance badly.
Fortunately, that's the case. So let's go ahead and open it up. We'll jump into the backstage portion with the group, see if anyone has some questions. Again, thank you so much for joining us, John. Appreciate it.
Yeah, you're welcome.